Hi everyone, this is the Finance Course Guru, and I'm going to help you today learn very quickly how to calculate the weighted average cost of capital. So the goal here is not to give a theoretical background on the weighted average cost of capital, which we'll call WACC from this point forward, but to show you how to quickly and accurately calculate the weighted average cost of capital. So there's three different components of capital structure, and those components are debt, common equity, and preferred equity. Now, I'm going to use the spreadsheet to walk through the example just really quickly, but we're going to assume we've already calculated our cost of debt, which is the yield to maturity, and let's assume that our yield to maturity at this point is 5%. Now, we have to adjust the debt cost for taxes. As we know, the interest is a tax deductible expense. So let's just say that we're in the tax bracket of 34%. Now, watch here in cell D5 when I hit return to send that formula into action, you can see that the cost of debt is adjusted for the taxation. So it's a 5% pre-tax cost, 34% tax bracket, and the formula here will show you how to calculate the after-tax cost of debt. So if you don't have the yield to maturity or a similar investment, you can use the rate function, and I'll create a video pretty soon to show you exactly how to do that. So now we have the cost of preferred stock. So often it's the dividend per share, and let's just say that we're sending out $1 per share in dividends, and we'll say that's each year. It's a full dollar per 1 year on the dividends. And now we have the price. So if our dividend's $1, our preferred stock is selling on the open market at $10 per share. It's a 10% cost before the float. Oftentimes these problems won't get into float, but it needs to be addressed because it often needs to be discounted. If your problem you're working on doesn't mention float, you can just ignore it for the time being. So let me just show you again this formula and how it works. We're going to have the dividend, which is essentially the cost, right? But it's stated in dollars, divided by the price, what we get to take in, versus the float cost. So not too tough. Now there's two different ways that we can do equity. We can use the dividend growth model or the capital asset pricing model, and some of your professors may refer to this as the security market line. So we'll just go ahead. We've been working with dividends already. Let's go ahead and skip to talk about the cost of common equity. Again, there's another video on the same channel here at the Finance Course Guru that'll walk through specifically how to do each of these components and cost each of these components but the goal here is to talk about this weighted average cost of capital with just a touch on the components. So let's say that right now the risk-free rate of the market's right around 2.5%. And the market risk premium that we'll have is going to be the market rate minus the risk-free rate. So let's just say right now the market's returning 7%. But we need to take a risk-free rate out of that. Let's say that we have a beta. A stock is not too awful volatile of 1.07%, and that's going to give us a common cost of common equity sorry, what was the result there? 7.32%. So we can go back and look. Actually, the CAPM model is not too bad, so it's not really tough to work your way through, but now you can see exactly how it works, and you can find that formula in any textbook, certainly the one that you'll have. So once we have all these weights, we can go down here and start adding. So we know that our after-tax cost of debt was 3.3, and we can see everything else. So we have 3.3% cost for debt. Our cost of preferred, as we see here in F9, is right at 10%, and our cost of common equity, as given by the CAPM model, 7.32%. Let's just assume, and this wouldn't be the case in any practical application, but just for the sake of seeing how this works, let's assume we have an even split on our capital structure. We have 33% debt. We have 33% cost of preferred, or 33% preferred, and we have 33% weight for our cost of common stock. So we're a percent off there. That's fine, because I'm Go back and change these. It's a little closer. All right. So what we have then is we have our cost times our weight. Cost times weight equals the contribution to the weighted average cost of capital. It's the same formula for all. Let me just show this to you. So we have our equals our cost times our weight gives us the contribution for debt. I'm not sure why this reset. Let me just go ahead and fix this for us so we can see. Okay. And then we have our cost times our weight gives us our contribution for the weighted average cost of capital, and the cost of common stock times the weight of common stock gives us the contribution to WACC from the cost of equity. And again, let me just show you this formula so you can see how it works. Add these together, and we're going to come up with our 6.87%. So in this case, 6.87% is the weighted average cost of capital, given the cost of those three instruments and the equal distribution of weight, which again would be different in many different situations. I hope you found this helpful. Check in for more. I'll be going over topics very often, and we'll do them quickly and succinctly so you can get on with your work. Thanks.